Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. I want to talk again about the new capital proposals. And the way that we want to think about this is in terms of the FDIC assessment. And I want you to think managers, also directors, in terms of large amounts of money we paid into the FDIC to pay for the community bank failures out there. Significant dollars. So the way that we want to think about the new capital proposals is that will it prevent us from ever having to pay large amounts into the FDIC again? And my feeling is the capital proposals do not prevent community bank failures. What we see in those particular proposals do not get at the heart of why community banks failed out there this time around. And it's based upon old-time type of facts, and we'll get into that in a second. Because when we look at it, that with the Seafried and Brew Total Risk Index is that we were able to predict 99% of the failed banks. And it's based upon, once again, traditional conservative community banking factors. The argument is that the banks that failed, it just wasn't the economy, it was the economy that pushed their risk over the brink and caused the bank failures. So that when we look at the S&B Total Risk Index, you can see that it started its upward projection 2006, 2007 into 2008, which led into the bank failures into 2009. These banks were taking overall inordinate amount of risk in here. You could say, well, was it just the loan portfolio? And I would sit there and say the loan portfolio definitely had a factor. What we're comparing here is the S&B top 15th percentile compared to all of the banks that failed in here. And you can see that our top 15th percentile, which is considered to be a low risk, high reward type of banking model, had much less credit risk than what the overall failed banks had. But then you can also look at it from the standpoint of liquidity. And you can see the top 15th percentile had no liquidity risk indicators. Yet, not only high, but even going higher as we moved into 2007 and 2008 for the failed banks. Because they were depending on not that core funding like the top 15th percentile, which you can see had no non-core funding whatsoever. They depended on hot money to fuel their growth into loans that were risky type of loans, the development kind of loans. 32% of the loan portfolio were in development type loans being funded by hot money. So when we review and go through this is that they didn't have enough capital compared to the top 15th percentile to really offset their overall risk that then led to failure. So what do we see from this in the capital proposals? Absolutely nothing of these main reasons that caused the bank failure. There's nothing in there to prevent community banks from doing again what they did during the great financial crisis, as well as going back in history, back to the recession, say in 1992, that caused bank failures. So when we look at this and think about it, that we want to have capital proposals that offset capital and risk and prevent future bank failures so that banks won't take steps with very little capital to take on large risk. And that should be what the new capital requirements can be. When we look at it from an overall basis, we've had a number of bankers that have gone to the informational sessions that the regulators have been doing. What we found is that the regulators seem to be saying, well, these new capital proposals are sort of for large banks and international banks. They don't really apply to community banks. But instead of just complaining about it, the regulators have said, tell us what we should do in terms of our capital proposals for the community banking industry. And for instance, you could look at it in terms of having an independent risk analysis, say like the S&B total risk. And depending on where your risk lies from an independent point of view, is that then that might suggest different capital levels. So for a low risk bank, I think that they could have a minimum capital of 7%. To be conservative, maybe 8%. We look at moderate risk banks. Maybe in this realm it could be 8% minimums, going up to, say, maybe 9% minimums. So once again, going back over history, that it wasn't the moderate risk banks that caused problems to the system, but you might want to have a little bit more of a capital buffer to offset that moderate level of risk. And high risk. High risk, if a bank is in a high risk position, that once again you might set, for instance, 15% to 20% capital levels so that they have a large buffer in order to take on that risk. So another method, which I think would also work very effectively, is use the same quantitative and qualitative analysis that you're doing as part of your overall reserving in here, in your ALLL analysis in the capital plan. That if we look at it from the standpoint of that kind of quantitative and qualitative analysis, is that then a lot of forces come together and do it under the capital planning process. Because when S&B does our capital planning, is that you can see it's not only a capital plan, but it's a risk assessment too. And when we look at that risk assessment, part of what we do are stress tests, just like the Fed did on the largest banks. Looking at credit, liquidity, and interest rate stress tests to sit there and say, do we have enough capital under stress? And then to sit there and quantify the actual capital that would be needed to offset the risks that we're taking. So once again, within that sort of assessment process, one then comes up with not only is your current capital adequate, but future capital also is adequate based on our strategic direction. So the capital requirements must be community bank focused, not Basel III focused in here. And if we can do this as an industry, once again, we protect our FDIC insurance fund. So this will not happen again. And once again, as an industry, we have to say we want capital requirements that fit the industry, not some international situation like Basel III. Once again, my feeling is write the regulators in terms of these capital proposals, saying that these won't do. If you want to, email this webcast to your regulators and tell them that you agree with our points of view. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.